Hello, thank you for joining our quick tax tips for Indiana Navigators and Vita sites. My name is Lucinda Nord, and in Indiana Association of United Ways, we have the unique position of working in both the Navigator and the free tax prep community. We help people enroll in health insurance, and we have helped people with free tax prep in filing their taxes. So today I'm joined by Kate McKnight from the Internal Revenue Service.
I'd like to thank all the navigators on the line because we certainly appreciate your trying to learn a little bit more about tax implications. And thanks to all of the Vita volunteers and site coordinators who may also be on the line. This type of cross-training is as important as is our shared outreach.
Great, thanks, Kate. In this short presentation, we hope to provide you a few quick tips with links where you can learn more information about each topic. As we know, enrolling in health insurance may be the easiest part of the process. The challenge actually comes from the various life situations such as divorce, custody issues, household changes, and variations in income due to job loss, unpredictable hours, or self-employment. Those same life situations complicate tax situations as well. So we're going to cover these four items today. So before we begin, let's remind ourselves the basics about the Affordable Care Act, or the ACA. We're now in our 5th year of implementation, but really only the 2nd year of the shared responsibility payments, or the penalties for not carrying insurance. And we're in the 1st year of HIP 2.0, or what's known as Medicaid expansion in our state. And no one likes to owe taxes at the end of the year. We want to make sure that the Navigator and Assister community understands the basics to help your clients with the right insurance and the tax credits for them. So let's look at the ACA from 3 different perspectives. We're going to look at it from a navigator's perspective, from a tax preparer's perspective, and then from a taxpayer's perspective. So all the navigators on the line probably already know this. The individual mandate provides an incentive for the consumer to enroll insurance, when the employer mandate helps us identify which employees might need help. Navigators also need to understand that not only does income drive eligibility in terms of whether a person is eligible for HIP or Marketplace, but the income is calculated differently for taxes than for insurance enrollment. And that's probably a big aha for those of us who's been working in this. We also use that to help identify who's eligible for cost-sharing reductions and the advanced premium tax credit. So this is just from a navigator's perspective thinking about taxes. Now let's go to a tax preparer and then a taxpayer's perspective.
Well, from a tax preparer's perspective, the Affordable Care Act adds new questions on tax forms and new training that our volunteers need. The Affordable Care Act provisions for calculating penalties and credit reconciliation are pretty straightforward for simple life and income situations, but they become much more complicated with the complications of life, like marriage, divorce, custody issues, household, and income changes. So now let's look at things from a taxpayer perspective. From a taxpayer's perspective, the taxpayer may not see the direct connection to how they enrolled in insurance last year and the tax consequences they're going to feel in February, March, or April of the following year when they actually file their tax return. They may not have understood the individual mandate, or they may have felt that their employer-sponsored insurance was unaffordable for their budget, but not by the Affordable Care Act or the Internal Revenue Service's calculations. And they may not understand why they would owe if they made monthly payments all year for their premiums on what the Navigator or healthcare.gov suggested. And they may not understand why their normal tax refund is reduced, or why, if they're not getting a refund, why they might owe.
Thanks, Kate. So here's another way to look at those different perspectives. And again, just thinking, each of us bring a different perspective to this, but in both the tax preparer's mind and in the navigator's mind, we're really worried about the client or the individual taxpayer. So let's talk about that shared responsibility payment first. So for the tax year 2015, um, this last filing year was the first year that we actually saw it in the tax filing season. But for the people today carrying health insurance or not carrying health insurance, the penalty actually increases for not carrying insurance to $325 per person or 2% of income, whichever is greater. So we encourage navigators to help folks understand that the penalty is increasing in each year and use this as a motivator to help you help the client decide to purchase insurance. And this line up here on the 1040 is actually where we see that shared responsibility payment. Healthcare.gov has some helpful graphics if it would be helpful to help your clients understand. And again, this gives you those 3 years. This last year that we just, for those who filed in February, March, or April, who had to owe or maybe got a refund then, 2015 you can see, and you can see how the amount really increases next year. So that next filing season, you can start to educate folks. For the navigators on the line, you can start to educate folks that it's going to really increase next year in terms of the responsibility payment or the penalty. So I'm going to let Kate talk about ACA reconciliation.
So what is the Affordable Care Act reconciliation? It's basically the end of the year adjustment or true up from what was taken out and what is actually owed. So just think about when you take a new job and you have to determine whether you're going to claim 0 or 1 or 2 as your personal exemptions on your W-4 when you get your new job. The number you claim as an exemption on your W-4 is going to impact whether you will receive a tax refund, whether you'll break even, or whether you're going to owe when you file your taxes. The Affordable Care Act reconciliation is very similar. So if you take too much advanced tax credit during the year, then you might have to pay some or all of it back. And if you didn't take enough, then you might receive a refund. So let's talk about reasons why people had to repay credits. This is what we observed in tax sites across the state last filing season. The tax credits are designed to be able to take them during the year in order to reduce the monthly insurance premium, or a taxpayer could opt to take the credit at the end of the year as a refund when they filed their tax return. If your client takes too much advance credit during the year, then they will need to repay the difference. Now, there are 3 main reasons Hoosiers had to repay during the reconciliation process. Number 1, their income was calculated incorrectly. Number 2, they selected an advance premium tax credit that was too high. Or 3, their income or their situation changed. Here's an example of the Form 1095-A. It's an important tax form that is sent to taxpayers in January or early February. Taxpayers need this form when they get ready to file their tax return. The 1095-A form shows the cost of the premium, the amount of the second lowest cost silver plan in the area, and the amount of advance premium tax credit actually received by the taxpayer throughout the year. Now this year, we had a number of people receive revised 1095-As with revised amounts in column B, which affected the reconciliation. Now, let's talk about how lower income clients are protected by the repayment limits. Middle income clients risk much larger repayments than lower income clients, and they risk these larger repayments if they took too much advance premium tax credit. Telling a taxpayer that they owe $600 or $1,000 or more dollars back when they file their tax return is not fun for our volunteer tax preparers.
That is true, Kate. So let's work through some tips to help our navigators get it right. And we've sort of boiled it down. We know it's really complicated. This is a lot of information, but in essence, we want to boil it down to 4 areas. One is in income and eligibility. Another is in selecting the right plan. 3 is taking the right amount of tax credit. And then 4, what you as a navigator can do in terms of providing take-home information about the consequences and about how to report changes. So let's walk through. In terms of income and eligibility, as Kate mentioned, one of the things that we have seen a lot, and this I think is just the nature of the first year, is the calculation of income. You know, for most other programs, Social Security income is exempt, but not for calculating income, modified adjusted gross income, or MAGI for marketplace plans. So we have a lot of cases where like a 55-year-old woman who's married to a 66-year-old man, where they may have Social Security in the home, didn't realize they needed to calculate that Social Security on their income. So this is one of the first areas that we see we need to get it right. We need to make sure that we're calculating their income correctly. And it may be because the clients themselves tell us, well, I don't have any other income, because they're so accustomed to not reporting Social Security income. So remember how the MAGI is calculated. And this may be that the client did it on their own. The second area is in the area of selecting a health insurance plan. You know, navigators are really good at helping families decide which plan meets their need based on health issues, what types of medicines a person may need, what type of hospital preference or hospital network or preferred physician, and looking up whether that physician is in a particular plan. Navigators are really good at this. Where we're not so good is maybe in the financial need, the financial preferences. So a lot of us have been trained as navigators to really look at the income eligibility and then try to work to make that plan affordable for the client. But what I want to encourage you to do is think about their financial health and how that's tied to their physical health. Because what we know is that the finances sometimes change, especially with the population that we're talking about in the area of that lower income but still have income kind of category. So we need to think about, you know, what does the client expect in terms of copays or out-of-pocket maximums. Also, you might want to even just start asking, you know, are you the type of person who usually likes to have a refund at the end of the year? Do you like to break even where you may owe a little or you may have to get back a little? Or do you mind owing at the end of the year? Because that question, the answer to that question will help you determine how much risk, in essence, before the client locks in on an advanced premium tax credit. So it's not just selecting the plan, but selecting the type of plan that matches with their financial needs, because there's a wide range of plans, as some of you have seen over this last year. So let's talk about how APTC works. So this is an old graphic that I stole from State Health Reform Assistance Network to just give you an idea that the eligibility for assistance under the ACA ranges from 0 to 400% of the federal poverty level. This chart shows how people with income below 138, right here, qualify for HIP, or what's called our Medicaid. And under 250% of federal poverty qualify for the cost-sharing reductions. Now, the advanced premium tax credit range for Indiana is the range between 138 to 400% of poverty, and it has diminishing levels of APTC. So that just gives you an idea of how the income thresholds interact with the tax credits. And let's just walk through a hypothetical example. So this is just a pure hypothetical example about a client named Susie. So let's say she's in healthcare.gov, and there are 2 steps. One is locking in on an APTC, or an advanced premium tax credit, if the client is eligible, and then the second step is selecting the plan. So let's say Susie's comparing 3 plans that range from a bare bones plan to what she's considering sort of an out-of-reach plan by her budget. The APTC, or the Advanced Premium Tax Credit, is going to reduce her payment. So let's say there are 3 plans that cost between $350 and $595 a month, and she says, oh my gosh, Plan A is just out of her budget. And let's suppose that her maximum amount of APTC is $350 a month. She could apply the full $350 to all 3 of those plans to find out what she would owe. But she could also take less than what the maximum advanced premium tax credit is and maybe afford a little bit more. So if she's choosing Plan B, I might ask her, I hear that you also take overtime, Susie. Is there a good chance that your income's going to go up substantially through a lot of overtime right before the Christmas season? Maybe she might want to pay a little bit more toward her monthly premium, especially if she's the type of person who prefers to have a refund at the end of the year. She may also choose, because she's really healthy, to go with the bare bones plan, where she's at a zero-based premium. So it just depends on her needs, but you might start incorporating some of those conversations with your clients about what is your preference around getting a refund or owing at the end of the year, and how likely is your income to stay at exactly the amount that we've plugged in to healthcare.gov for the eligibility. Those 2 questions will really help you determine where she should lock in her advanced premium tax credit. And we know that that's really hard for predicting income for people with unpredictable work hours or those who are self-employed. So it may take a couple conversations to nail that down. So now we want to talk about what a Navigator gives to the client to take home. It's important to provide information about the consequences and changes. We're aware that many of you send a one-pager or a packet of information home with your clients. I've heard consumers going home with packets of like their login and password, especially if they didn't have an email address before they started. Maybe the Navigator contact info saying, call me if you have issues arise. Don't hesitate to call us back and we'll help you work through those issues. Some of the Navigators actually include the plan information, maybe with a number of plans, and they just circle the logo to show them what kind of mail to be looking for in the mail. And they also might include that plan's contact information and what anticipated date to receive their insurance card in the mail. It's really important to provide the client payment information, since they have to make that payment every month. How much, when is it due, where and how to pay it. And then a lot of Navigators are starting to include the coverage to care information. How do you use your insurance? Where can you go to find out more about how to use your insurance? So this is what a lot of Navigators are already doing. What we might encourage you to do is to add a little bit more to your take-home information. So one piece of information to include is how to report information about income changes, life changes, or address changes throughout the year, and how that if there's a radical change, the client may need to reset their advanced premium tax credit or start saving up for an end-of-the-year repayment if that's at risk. That might be okay because in essence, it would assume that they got a better job or they got more hours where their income went up. But if it went up substantially, they may need to recontact the marketplace. You may want to make sure that they know that if they purchase the marketplace plan, they need to start looking for that 1095A form that's going to come in the mail. It will be marked important tax information, and tell your clients to take all of your important tax information forms to your tax preparer. It's a good way to educate them about how important it is to put all of those forms together and to keep them. And then they also need to file their tax return. As you can see from our other documents that we submitted or sent out to you, we know that there are thousands of Hoosiers who have received a letter from the IRS saying that they have not received their tax return for this year. That would make them ineligible for the marketplace next year. So we want to make sure that they retain their eligibility. And these are often, again, families who may not have had an income that of the filing threshold in prior years, but because they're taking a marketplace plan that involves advanced premium tax credits, they need to make sure that they file their return. And then you can also educate them about calling 211 or using My Free Taxes for free tax filing, free tax preparation. There's no need for them to pay someone if they don't have to. So what we'd like to do is just sort of sum all of this up in a nutshell, that we, the Navigator community is really good at helping people get access to health insurance and then use their health insurance. And we want to just remind you that, it's incumbent upon all of us to help consumers understand the penalty and that it's increasing each year, that there's no better incentive right now than to get enrolled if they don't believe that having good health is a good enough reason. We want to make sure that consumers get the right plan for their health care situation and the right amount of credit for their financial situation, because we know that financial and physical and mental health are all connected. We want to remind consumers to report the changes that happen in their life or income, and to keep all of those important papers and then file their tax return next year. Usually that starts around the week after Martin Luther King Day and runs through April 15th. And then you can let them know where to they can be referred for additional information. We have a number of resources for you that we've provided the links to that include some videos as well. So let's just highlight a couple of these. There is a guide for the assister community that is very tax detailed and wonky. It may put some of you to sleep, but for those of you who are really interested in the tax consequences, Health Reform Beyond the Basics will update this document as well. The last one is based on 2014 data. The marketplace has a lot of tax information. The IRS has some great quick and dirty videos that you can watch in terms of ACA videos, tax implication, and estimators. Estimators for the individual shared responsibility estimator and premium tax credit change estimator. You might try those. Indiana 211 has a number of reports, and then if you're curious to test yourself, I've pulled this little tax quiz related to the ACA. If you want to give that a whirl and test yourself, test your navigators, have a little contest in your navigator organization. And then lastly, if you're really into the tax implications of the ACA, Health Reform Beyond the Basics is offering a 4-part series, very detailed about tax implications. And we've posted the dates there and the link, so you can certainly register for those. So lastly, we will open it up to questions, and also ask that if any of you have great tips that you'd like to share, we'd welcome those. We will be doing a question and answer document as well. So let's see. Type your questions in the question box if you have a question. I have a question. We have them IUW tax training. I'm not sure what that means. If you could clarify, Kathy. Let's see. Do we have any questions? I'm looking through the questions. Anybody have any questions? Oh, now the questions are coming in. So the question is, for the folks who had a marketplace plan and have not filed their 2014 taxes, does this mean they're going to be locked out of the marketplace? Or will the marketplace reconcile that, or recognize that they didn't reconcile and not offer them eligibility, just make them repay any credits if they did not file? Kate, what is your understanding of that?
Well, taxpayers are required to file a tax return in order to have their income verified, which will help the Internal Revenue Service verify their eligibility for receiving the advanced premium tax credit for the coming year. So if they do not file a tax return within the next couple of months, they will be not eligible for receiving the advanced premium tax credit. Now, people can continue to file their tax returns even after October 15th of this year. It's just going to mean that they might be liable for some kind of a penalty because they weren't covered under part of the year, or they might be liable for a penalty because they didn't have the assistance of the advanced premium tax credit. So it's possible that they would get a penalty if they don't file. I hope that answered your question.
Right, and it's my understanding that they will not be eligible for the credits going forward until they got that reconciled, until
Right.
they file their tax.
Yeah, that's very true, except that, we'd like everybody to get their return filed as soon as possible, but we know that some people will be filing, as time goes on. Once your return is filed and processed, then the Internal Revenue Service can verify your income, which will then make people eligible for the payment of the advanced premium tax credit in the future.
Okay, I have a question, and I apologize to anyone up front. If you offer a very specific question about a client situation, we may have to get back to you offline about the specific cases. I'm reading through here. We have a question about a spouse on Social Security disability, and she works as well. She carries the insurance on both of them. She was told that the disability is not taxed. It's not taxed from an income tax situation, but it is still required to be part of the MAGI calculation, as my understanding. Kate, do you have any other information?
That would be true, because they're going to look at non-taxable income as well, and if it's Social Security disability, it's very likely that would be added back into her income, just like her W-2 income would be. So yes, that's correct.
Okay, thank you. And then we had another question, this may be more complicated, about self-employed folks. We had a question, a number of my clients are small business owners and it's hard for them to predict their income. What is your suggestion? This is a tough one that Kate and I have talked about before. It is very difficult to lock in to an advanced premium tax credit without some level of confidence about the predicted income. So, this may be where a conversation with the client about their comfort level with risk of how willing are they to have to pay back would be my suggestion, or to really overestimate their income and then be pleasantly surprised with a higher refund at the end if their income doesn't come through that at that level. Do you have any other suggestions, Kate, for self-employed who have unpredictable income?
I think your suggestion of asking questions about the comfort level that the taxpayer has with risk is an excellent one. Depending on the kind of business the taxpayer is involved with, if there are certain clients that the taxpayer normally has on an annual basis, you might want to ask them, if they're fairly certain that their biggest clients are going to continue with them throughout the years, or what the risk factors even are in their businesses. Because as the economy improves or maybe doesn't improve in certain sectors, that may impact their business as well. So it all comes down to risk, and nobody has a crystal ball, unfortunately.
Yeah, it's a tough one. I have a question This is a great question that I apologize. I have not clarified the answer for this, and I don't know that Kate will know. I'll ask the question, and we may say we need to come back to you. So the question is around the HIP threshold. So if HIP, as people have their incomes bump above they may have been enrolled in HIP, and then they bump above the 138% of federal poverty level, we can get them into the marketplace on a special enrollment period for losing their coverage through HIP. But if these individuals also have incomes that fall below the 138%, sorry, I just lost my question, during the year, will they be required to pay back the tax credits? So if someone switches from marketplace to HIP, Kate, have you received any additional guidance about whether or not they will have to repay tax credits?
I have not, but if I understand the question, they would have had, the taxpayer would have had insurance under HIP, right? So they would have
Yes.
had minimum essential coverage under HIP. Then they are going to go into the marketplace and purchase insurance. And then if their income falls beneath that 138% of poverty threshold, they would go back to the HIP plan.
Exactly.
Is that true? So if there's continuous health insurance coverage, there's no problem. They're not going to have to, well, they, at least they would have had the health insurance.
Right.
The issue is we would have to know, again, it's kind of like estimating your income and how much risk are you willing to absorb, because we are going to be looking at the income.
Right. So the person would not have to pay a penalty because they had continuous coverage. And even if there's like a little grace period in between, like I've had a client say, I didn't have a full month of coverage. There's a little bit of wiggle room there. But the question is, would they have to pay back advanced premium tax credits? And I think to Kate's point, it depends on how high the income went above the 138%. And we will clarify that. I know I've received that question from a couple people. I have just a couple more questions and then we'll wrap up. Let's see if I can, this is a long question, so my apologies. If an individual has monthly income too high to be eligible for HIP, but has an estimated annual income too low to qualify for an APTC, but will estimate their income based on the healthcare application to be higher so that they can collect it, will they have to pay back all of the advanced premium tax credits if they fall under the 138 when they actually file their taxes? I will have to get back to you on that. There's a number of situations. We were given guidance at the beginning of the year regarding the folks who had transitioned from marketplace plans to HIP, but I'm not sure about the going forward. So if I could, I apologize to those who are asking similar kinds of questions, but if I could defer, we could get clarification on that question because we want to give you the right answer and then get back to you via email. A similar question, what about the individuals who fall between 13 and 100% of federal poverty level at the end of the year? Will they be able to be considered for the repayment limitation? If their income is below 100% of federal poverty level, my understanding is they would fall under the exemption. Is that your understanding, Kate?
Yes, they would be exempt from the penalty.
Okay. And again, we'll clarify that as it relates to the marketplace. Oh gosh, questions are just flying in. The state is calculating income monthly, whereas the marketplace calculates income annually. So there's going to be some discrepancy between the eligibility of the two programs. Absolutely true. And this is one of the pieces of information that we've tried to share with policy leaders because those of us who work with low-income folks know that their incomes fluctuate. We have a lot of folks who get seasonal employment or a lot of overtime during certain seasons of the year, whether it's construction during the summer or those who work in retail in the Christmas shopping season. We know that there are some great discrepancies in work scheduling and hours. So So it's just a conundrum that we haven't figured the answer for. So let's see, I have one more. Okay, so the question, and again, this is one that I do not have the answer to, but we will clarify this. If the person has taken a new job, but the new job does not offer health insurance for a waiting period, will they be penalized? And I think the question is, it depends on the length of time before the waiting period is over. So there is a short grace period. I will clarify what that grace period is for that exact situation, but I don't know if it would last for 60, 90, 120 days. Thank you. I'm getting a response from Benjamin that there's a 3-month grace period. Again, we'll clarify that just in the question and answer when we send it out. We're providing the most accurate information, but it's our understanding, according to Benjamin, thank you, that there's a 3-month grace period. We'll want to clarify that and get that out to you. Okay, so I am not seeing any other questions. In terms of contact information, this is our contact information, and what we're going to do is we will close this. We thank all of you from the Navigator community and the Vita volunteer community for participating in this tax tips webinar. We know that there's a lot more detail, but we just wanted to give you a brief summary, and then there may be some other questions that pop up that have us do a call to. So this concludes the recorded part of the session. Hold just one moment and we'll be back with informal question and answer.